All right, there's nothing left in the piggy bank. Now we get dark, okay? The US national debt to GDP has surpassed World War II levels. We now have $31.2 trillion. Our debt to GDP is 122%. We know from economic studies, once a country gets more than 90 and certainly 100% of debt to GDP, they start struggling with being able to manage that level of debt. Why? Because growth rates slow down. The amount of resources have to go to service that debt grow and grow. Remember last year I said there's only one of two options this country has because we're at the beginning of a debt trap. We're in the teeth of it. We can either default, which we can't, because if the US defaulted on its debt, it would send the whole globe into depression for decades. You would wipe out literally every financial entity around the globe, most governments, most pension funds. So the only other option is to inflate. The problem is they don't want runaway inflation because then you start getting something called stagflation and you start breaking your economy apart, like what was starting to happen in the 70s, but what really happened in countries where they get hyperinflation, like Weimar Republic in Germany, like Argentina, and you can go through the litany of Latin American countries that this has happened to. Now, this also explains why we're in a debt trap. The circle. That's 2021 outlays by the federal government, $6.6 trillion. At the very top, you see the gray, net interest. That was the cost of paying our debt. Just the interest cost was $345 billion in 2001. Our interest cost actually went down, even though our debt was going up. Why? Because rates went to zero. The Federal Reserve was financing things at almost no cost. The problem now, as rates start to rise this year, our interest cost now in 2022 is $534 billion. And if we go to up another 200 basis points, which we already have, this year, in 2023, it could be $992 billion, almost $1 trillion. If it goes higher, it could be $1.2 trillion. Therefore, you go back to this, it will be bigger than anything other than Social Security. Just the cost of paying on our debt will squeeze out all other expenditures. That's why we're in a debt trap. Therefore, what is the Fed going to try to do? Forget about them getting back to 2% inflation rate. I don't think that's their goal. What they need is inflation running at around 4 or 5% consistently, where it's not blowing everything up, but it's consistently eroding the amount of debt. Because how do you get rid of debt? You inflate your way out of it. The problem is you have to walk a tightrope, because if they shove too much money into the system, inflation takes off again. If they take money out of the system, what's happening? Asset values are going down. Tax revenue goes down. The US government's going to receive a lot less money. California, I can guarantee you, will be back in financial problems in a year or so, because California has benefited from all these capital gains from the tech industry, which is drying up now that all the losses that are coming. So this is the heart of why I say we're in a debt trap. You're damned if you do, you're damned if you don't, and you have to walk this perfect tightrope. I think we're going to live through the next decade of swings of inflation and swings of deflation, and hope we can all navigate through it. Now, I thought this would be interesting just to show everybody. If the US government was a family of three, we had already gone bankrupt. So the median US family of three people makes $45,986, basically $46,000. If a family spent like the federal government, it would be spending call it $59,000, which means they would have put another $13,000 on their credit cards after already racking up almost $300,000 in credit card debt. To say the least, they would have gone bankrupt, 5, 6, 7, 10 years ago. That's where we are as a federal government.